Hello and welcome to Payden's 2018 Economic Forecast. By way of introduction, I am Natalie Headland. I've been with Payden for 5.5 years and am the dedicated coverage for the Northeast. I'm pleased to introduce our speakers today, Jeffrey Cleveland and Payden's Chief Economist, Peter Beer, integral member of our economics team. This team is responsible for our colorful commentary as seen in their quarterly point of view piece on all things relating to the economy. Before we begin, and to ensure a smooth webcast, I want to address a few housekeeping items. You have access to Zoom's chat capability where you can ask questions, lower center of your screen. We have dedicated time in our Q&A session at the close to address these questions. This is part of our webcast series. Keep a lookout for more information on future calls. A final note, this call will be recorded and the presentation will be sent out directly to you. Without further ado, here are Jeffrey and Peter to take it away.
Well, hello everyone, it's Jeffrey.
Good morning, this is Peter.
And we are two members at least of the Payden Economics Team. Our third member, Sid, is not featured in today's broadcast, but he's here with us running all the technical background, advancing the slides. So Peter, it's that time of year again to do an outlook, a forecast for 2018. It's always an interesting time of year because there are just so many outlooks and forecasts, and there's a lot of noise. And I think, what do we try to do that's different than what other macro forecasters are doing? I think that's the key question.
Well, I think most macro forecasters just look at the consensus and then either copy it or shave it up or down a few basis points. But we have a slightly different approach predicated on the idea of narratives, which Jeffrey can explain at length. Here are our bios and some of the stuff we do, which some of you may be familiar with. If you open your inbox early Friday mornings, maybe you see the chart of the week. If you don't, let us know. We'll happily spam you with that. But otherwise, I think I'll hand it back to Jeffrey to kind of talk through our approach and the way we think about narratives in financial markets.
Well, the world is a complex place. There are a lot of moving parts, and everyone has to develop, if you want to call it a mental model of how the world works. We like to call it a narrative. It's a story. And we need stories because that's the only way we can grapple with the complexity. The problem with stories is that oftentimes investors, traders, they believe in their stories. They think their stories are true. They're real reflections of reality. And that's where we see investors getting into trouble. I think this happens, Peter, every year. It's 2 or 3 or maybe even 5 different stories that people become very attached to, and they use those stories to formulate their investment thinking. But in the end, those stories turn out to be wrong. The photo we have here to reflect this is, you go out into the wilderness and you see a nicely manicured ski resort. So you think everything's under control, but when in fact, that's just a little story you've told yourself. Reality can oftentimes be quite different. Actually,
you don't even know how to ski, it turns out.
Actually, to be honest, the left-hand photo here, the expectations photo, that actually is, my colleague here, Peter Beer, standing, gazing out at Convict Lake in Mammoth. So this is a live example. So every year there is a story that really captivates markets, that investors get really enamored with, that turns out to be wrong. And so what we wanted to do and what we try to do every year is poke holes in those stories. And by doing so, we hope to find out something about the economy, about the markets, about what's priced in, about what's not priced in, and we can take advantage of that. So we've picked a handful of narratives that we think are really popular right now, but are wrong. And that's what we want to talk about today.
But first, as with every good storyteller, you got to go back, look at the story you told yourself last year, and figure out what you got wrong. So we're by no means are we immune to picking the wrong story or believing in the wrong story. And we'll start with what you might call a post-mortem. We put on our coroner's hat and dial up last year's big mistake.
Inflation. We got inflation started the year, at least on core PCE, close to 2% on a year-on-year basis. Core CPI was actually a little bit above 2%. And then, Peter, what happened?
We took a dive.
Walk us through the autopsy here.
we took a big dive. And of course, the reason that we care about this ultimately is because for the Fed, as they set monetary policy, hitting that 2% target on core PCE or really core CPI, any kind of broad inflation measure is important as a reflection of kind of aggregate demand across the broad economy. So what happened last year? Well, I think one way to think about it is to take the entire index, in this case we chose CPI, and to imagine that the whole big box you see represents every single part of that index. And then we can carve it up by different categories, and with the area of each category representing its weight in the index. So you see shelter is a big component, in this case occupying a little less than 20%. And you can see kind of various things. Motor fuel is also a decent share, and we colored each box by the rate of change for year on year. And what you can tell, in addition to gas prices being way up on a year-on-year measure because they were way down the year before, is actually telephone services, which we highlighted here in the center. It's not the biggest category, but it was down well over 5% year-on-year. And in some cases, actually, we were down on wireless services more than 10%. So you may or may not have noticed, but at some point last year, around March or April, maybe your kind or otherwise unforgiving, depending on how you feel about them, wireless service provider may have extended to you at the same price additional gigabytes of data, or you may have opted into an unlimited data plan at a fairly attractive price. And as good as that is for us as consumers, when the Bureau of Labor Statistics sits down to actually calculate inflation, they're trying to effectively put a price on a gigabyte. What does a gigabyte of data cost? So if you have now unlimited data at the same price that you were maybe paying for 10 gigs or 5 gigs, obviously that per gigabyte is going to go to effectively infinity. And while they don't reflect infinity in the data set, they do mark it down significantly. So that really explains a big piece of kind of what we missed last year and why inflation really took a dive. The other thing I would say, just with my consumer hat on, putting the coroner hat aside, last year we did see new and used motor vehicle prices fall. Good news, it's not really demand, but there was a lot of supply. And if you're looking to buy a car, maybe now's the time to get out there and sink your teeth into that new SUV you were looking at, because as of the latest data, we have started to see those prices level off. So maybe you could help the economy in your own way buying a car.
So mea culpa, last year we got the inflation story wrong. I think everyone was surprised by inflation. A bit of noise holding down the overall rate of inflation. And we'll get back into a little further discussion on inflation as the webcast progresses. So that was a look back. Let's look forward. I think these are the 5 narratives that we're hearing right now that we think are wrong. You could probably come up with a pretty long list. These change. Peter, I noticed some of these are changing a little bit just this week. The narrative that people are telling is changing. But this is what we settled on. This, number 1, perennial favorite, really. Politics is greater than economics, or politics is more important than economics, or this shows up in different forms. Here in the U.S., it shows up in the focus on Mr. Trump and his policies. Across the pond, it shows up in terms of just lingering fears about Brexit. But it's always something related to politics being this key concern for markets. Our view is that actually the economic backdrop looks fantastic, and that will countervail these wobbles or these concerns about politics. So ignore the political headlines. Turn off CNN, turn off C-SPAN, and focus on the economic data, which looks great.
Particularly if we think, Jeffrey, about global GDP this year. We were expecting really last year a pretty good turn. That I think continues into this year. And if we register over 4% on annual world GDP growth, that is a fairly rare event in the last few decades, and something we shouldn't take lightly. It's a really strong signal that the global economy is healing. And as we think about forecasting, we're not trying to pick out, whether the Austrian election is going to tilt to the alt-right or the young Social Democratic Party in Germany is going to capture some share. What we really think about are these four main drivers. And if you look, we've highlighted four countries in orange, and those four, China, India, the United States, and the Euro area, account for about 2/3 of global GDP growth. So if you want to get a bead on what is going to happen this year in terms of world economic growth, this is the place to start. It's also worth noting that actually this year we're expecting to see the fewest number of countries in recession that we've ever seen on record. And don't fret too much. Our comrades in Venezuela and Puerto Rico we do expect them to stay in recession, but in general, we don't have the drag that we saw, for instance, in 2008, 2009, when well over, almost half of the countries around the world were in recession. So that's a really, really good sign and a really important part for us why ignoring politics and focusing on the turn and the uptick in global GDP really drives a positive outlook for 2018 from a growth perspective.
U.S. actually also benefiting from this global backdrop that Peter's talking about. If the world is growing 4% plus, we think the U.S. is growing in the high twos, so somewhere around 2.7, 2.8 for full year U.S. GDP. If you look at the quarter-to-quarter annualized rate of change, we're going to get data actually sticking our necks out here. We'll get data on Friday on U.S. GDP. It probably exceeded 3%. So we'll add another 3% growth quarter to this chart you see before you. So you'll have 3 consecutive quarters of U.S. GDP growth above 3%. We haven't seen that sort of sustained growth since 2004. So the macro backdrop is really good in the U.S. and globally, and we think that outweighs all sorts of political questions.
Narrative number 2. One of the most popular things, we do work at a bond firm, so forgive us for our geekiness and focus on this, but our traders, our dearly beloved traders, are most fond of promoting the idea that 2018 will be the year of a flatter yield curve. The Fed continues to hike, raising the front end, particularly 2 years or 3-month bills. And at the long end, we've seen some backup in yields, but how do we get long-term yields higher? Maybe inflation turns, maybe that helps a little bit, but by and large, with the Fed still owning a large share and generally inflation under control, how could the long end back up? So this popular narrative of a yield curve is something that we think is worth taking a closer look at and trying to poke some holes in.
Yeah, and people say that it's a flatter curve, and it forebodes, or it's foreboding. It's an indication that growth is slowing and that a recession is around the corner. I think that's how I hear it most often presented to me. Is it true?
Well, we did take a look. Indeed, this is pretty much all we look at. And we, for reasons really related to kind of just working in line with research, we prefer to look at, when we think about the yield curve, we look at 10-year Treasury yields minus 3-month bill yields as our kind of gauge of the yield curve. And the reason that we care so much about this, like Jeffrey just said, this indicator, when it inverts, has, with only one false positive in the post-war period, predicted every single recession. So for us as forecasters, and for our listeners and for investors everywhere in the U.S., this is probably the best and surest sign we've got. It's not perfect, but alas, nothing is, and this is the best we can do. So the natural question, I think, is, okay, if inversion is the thing to worry about, does a flattening necessarily lead to inversion? Well, definitionally, yes. But the key takeaway for us, and the reason that we're not worried about a flatter yield curve this year, is that in the late 90s, we had 2+ years of a relatively flat yield curve. Even in the kind of 2004, 2005 period, we saw the yield curve flatten and had a few more years of good economic growth ahead of us. So, yes, we expect the Fed to continue hiking. Yes, maybe the long end of the yield curve backs up a little bit. And yes, maybe we end the year at a slightly flatter level. But it does not necessarily mean that this year we have a recession, and it's not something that you should worry about. Look for the inversion on this yield curve, not the flattening.
Perfect. Number 3, narrative number 3. Credits. Well, I think this follows perfectly on. I mean, if you're worried about a recession, you probably also think that credit spreads are too tight. And our view is that if the cycle persists, then credit spreads can remain tight. Actually, if we could go back, Sid, one slide. So just to put this in perspective, the left-hand chart here shows you every expansion in the post-war era. It shows you the number of quarters that have elapsed since the start of the expansion. And you can see the current recovery, which is now 33 going on 34 quarters, is getting close to the second longest on record. It's rivaling now the 1960s. I think we'll pass the 1960s sometime this year, I think by the second quarter. And then we'll make a run at the 1990s. So this cycle that we're in right now could end up being the longest cycle on record. Part of the reason is it's just been a slower, more drawn-out cycle. And I think this is the key consideration for me for spreads. The time to get worried about spreads widening is, as Peter said, after inversion occurs. So the chart that we showed before you, page 17, is looking at the very same yield curve that Peter has found in his research that has been a really good business cycle indicator, the 3-month T-bill to the 10-year Treasury yield curve, versus the Barclays U.S. Corporate Aggregate Index. And when you look at that, it does appear that the curve inversion gives us not only a heads up on a recession, but it also gives us an advance warning on spread widening.
And for all you stock junkies out there, I think this is actually as true for year-on-year change in the S&P 500 as it is for credit spreads, which obviously makes sense. They're both reflections of kind of corporate health and asset market performance. So even when we think about stocks, I don't think as economists we have particularly strong views necessarily on valuation, but what we do have a strong view on is that when the economy weakens and when we head into a recession, that is historically when we've seen the worst performance for equities. So if we don't see a recession this year, then like other credit products, whether it's high yield or investment grade bonds, stocks can continue to perform.
Now, it's also probably worth asking, Peter, we've looked at this, when the curve actually inverts, on average, how long does that happen before a recession begins?
We've seen generally anywhere from 12 to 24 months. So you have a pretty good lead time. Although be forewarned, none other than Ben Bernanke, the last time the yield curve inverted, if you look in 2006, Ben Bernanke, who was the former chair of the Federal Reserve, gave a very famous speech, or now infamous, proclaiming that the yield curve as an indicator was dead and no longer useless. I may be slightly overstating his argument, but for the sake of our argument, I think expect if the yield curve inverts, in the next 2 years, that there will be plenty of folks remarking on how it's lost its utility as a forecasting tool. And we would say, certainly ignore that. Pay attention to the yield curve if you're thinking about whether you're thinking about the economy generally or credit spreads or equities more specifically.
Narrative number 4. Now, I've actually just walked out of a meeting internally here, and this was the actual quote in the meeting. So I don't think this is a straw man narrative. This is a live argument. And people look at core PCE, which is the Fed's favorite gauge of inflation, and it's at 1.3% year over year, which is admittedly low, and conclude that there is no inflation, that we will see a placid inflation environment out into the foreseeable future. Our view, but this is the 4th narrative, so I think you're catching on to the pattern here. We disagree. We think 2018 will be very different on the inflation front than 2017 for a couple of reasons. So before we have one way to think of this. This is page 19. This is looking at the core CPI measure versus the underlying inflation gauge, a measure of the trend inflation rate put together by the New York Fed. They've been tracking this for the last 3 cycles. They've only recently released it to the public. So if you are interested in new and interesting economic indicators to follow, Peter, I know you are.
I surely am.
That's how you spend your time. This definitely should jump up to close to the top of your list if you're looking for something to do every month. You can Google it and follow it. It points to higher inflation in the year ahead, we think. So I think that's one reason. I would also add a lot of other indicators we follow for leading indicators of inflation are pointing towards a pickup. So whether you look at wage growth and the unemployment rate now dipping, we think, below 4% in 2018. That should push higher inflation. Commodity prices, oil's up 15, 16% in the last 12 months. That should feed through into inflation. The dollar, Peter, has been weak for the last year. That should feed through into goods prices. And so all those different things that you would look to for an inflation backdrop are pointing towards higher inflation. So I think right now when people are saying there is no inflation, I think they're getting the narrative wrong. It was true for the last couple of years and certainly in 2017, but may not hold in 2018.
One nuance to add to that, I think there may be an opportunity early this year because of this narrative that there is no inflation for sort of a contrarian view. And the reasoning goes thus. So if we recall, Jeffrey mentioned that at the beginning of last year, the year-on-year rate of inflation was actually almost at 2% and fell all the way down to about 1.4%. So what that means in effect is at the beginning of this year, there's sort of a high hurdle. We were growing faster at the beginning of the year than we were at the end of the year. So when we look at the year-on-year rate of inflation for Q1 2018, we may actually see a few kind of weaker or disappointing prints. And if you do see that and you do in your client portfolios are thinking about ways to kind of opportunistically hedge inflation or to make an outright bet on inflation, Q1 is a good time to look for that trade, particularly if we see indicators like break-evens retrace some of their recent gains. And it may not happen, but I think that high hurdle from last year might present a really interesting opportunity this year.
So near term, expect a lot more noise on inflation. Longer term, we expect to pick up. Number 5.
Central bank balance sheets have been the great story of the last really pre-crisis, post-crisis period. Yeah, the last decade. And the flavor of this month or this year is really the ECB. And folks, just as they were concerned that when the Fed stepped away, yields would skyrocket. Actually, that was a concern every time the Fed changed its balance sheet program. But nevertheless, people have sort of migrated that same reasoning, despite how wrong it was, to the ECB. And that as the ECB steps away, particularly from buying corporate credit, that yields and spreads will back up and widen respectively. So naturally, we think this is massively overhyped. We plotted here kind of the Fed balance sheet, but this is really the key point. And I know this just looks like random bars, like maybe a barcode, but actually this is real information. So we have the market value of the ECB, of all corporate debt in Europe, and that's the blue line. You can see it's massive. It's just at about 2 trillion in euros right now. And then that tiny little infinitesimally small unimportant orange bar is what the ECB actually holds in terms of corporate securities. So we are not as worried. And yes, at the margin, maybe they have been an important buyer, particularly in the last year, but just at the outstanding aggregate level, it's an enormously small share for a nice paradox there. And it's not something we worry about, particularly in light of our growth outlook for the euro area. If, as we expect, the euro area economy continues to recover, led maybe this year by a pickup in Italy. We've seen Spain kind of turn the corner, but if Italy can really turn the corner, then that growth impulse will, I think, in our view, overwhelm really any marginal change in the ECB's balance sheet program. It's finally worth noting that just like the Fed, the ECB will not likely be selling securities anytime soon. So even if they stop buying, we would expect probably they will continue reinvesting in some fashion, and that will keep the balance sheet at the same size, and they will represent the same marginal demand that they've provided to the market for the last few years. So don't worry about the ECB, just like you shouldn't have worried about the Fed. We think it's overhyped, and we're looking for a good year in Europe this year.
So those are the 5 narratives. Economics is more important than politics, and the economic backdrop, as Peter said, looks fantastic. Don't worry about the flatter curve. It's the inversion that you should worry about. That is the key. Forget all economic forecasters, any human being, any black box model. The yield curve is the best forecaster, but it's the inversion, not the flattening, to look for. Credit spreads, we know credit spreads are tight relative to historical averages, but the key indication is, well, is there a recession around the corner? If there is not a recession around the corner, and we don't see one, then spreads can remain tight. We can expect some bouts of volatility, sure, but tight spreads, not that unusual. There is inflation. We think there is inflation in the system. We see an underlying pickup in inflation, and we expect that to be a big story, perhaps not in Q1, but as the year progresses. And as Peter said, far too much credit is given to the central banks for producing market outcomes and economic outcomes. There's some real strength in Europe that we're seeing. So those are the 5 narratives that we see being the most popular, and we wanted to pour a little cold water on them today.
But of course, we would be remiss if we didn't highlight one thing we worry about. Our fearless leader, Joan Payden, owner and operator of our beloved Payden and Regal, always asks, no matter how bullish or bearish we are, what are you worried about at the macro level? And I think if we point to one thing, obviously we've painted a very charitable or bullish view of the U.S. economy. I think one thing to worry about is the housing market. And what we've done, just to kind of contextualize this, is show the contribution. This is the quarterly annualized rate of change in residential housing investment. And so this is everything from single family to multifamily. And what you see is the last few quarters have been pretty weak. And while I wouldn't say we worry about this for growth, there are a few things to highlight in the housing market in the United States that are concerning. And if we start with affordability, particularly in coastal markets, the share of income that goes to housing payments has really elevated, kind of from, say a quarter of income to really a third now in some of the hottest markets. And that's true really for rental markets. I think it's also really important to highlight we've had really a decade of underbuilding in single family, particularly single family that's not kind of in far-flung suburbs, but in urban areas. And that may come to bite, particularly as millennials continue to age and migrate to home ownership. The lack of existing supply is really crimping. I should say it's really driving prices higher. And if you look, for example, there's a measure you can look at called the month supply of existing single family inventory, meaning at this sales rate, how many months would we have before there would be no more supply? And we're hovering just over 3 months, which is really half of kind of what we saw even 5 years ago, and definitely at decadal lows. So that, I think, is something to continue worrying about. And finally, if we're right, and if we do see rates pick up a little bit, there's no question that can only kind of crimp demand if we've had fantastically low interest rates, and would-be home buyers have benefited from that with relatively low interest obligations. But if rates do move higher, that's yet another thing to worry about. So I don't think we're ready to put the nail in the coffin and say the housing market is in big trouble. But when forced to wonder and forced to worry, I think we point to housing as one thing to keep your eye on in 2018.
So that's what we worry about. I think that's a key concern. And we've talked about the narratives. I think that the next logical step here is, okay, where does the rubber meet the road? What does this mean for the market? So we decided to summarize that in one page. We can do that. So just going down the list of topics, and then our key view. The U.S. and global economy, we're bullish, Peter has forecasted a 4% GDP growth for the global economy for 2018.
Feeling confident.
Feeling good. And, much of that is driven by improvement in the developed world. So the U.S., Europe, Canada, even Japan looks better in terms of the economic I can't believe I'm using Japan in terms of improved economic backdrop. That's what we see. And so we think that's key, that the cycle persists, no recession in 2018.
Number 2, yield curve flattening. We've harped on it. We'll harp on it again. That's how important we think it is. We're not worried about a flattening. If anything, we could see maybe an interim steepening. And we don't think, on the basis of this indicator, that a recession is imminent.
The unemployment rate, I think in the U.S., we will dip below 4%. We think it will get as low as 3.5, 3.6% during the year, which, Peter, that would be historically sort of a rare occurrence to be below 4%, 3 times since the Second World War, the 1950s, the late 60s, and just a couple of months in the 1990s. So virtually zero current investors, current market participants have witnessed a 4%, sub 4% unemployment rate for an extended period of time, maybe a couple months in the 90s. So I think this is really an important event. I think it will drive the Fed's thinking and the overall macro backdrop.
Not only that, if, as we've suggested, inflation continues to rise this year, no matter what happens in Q1, but really over the balance of the year, that's yet another reason to kind of knock 2 out here at once, that we expect the Fed to, on the back of what Jeffrey articulated in the labor market and on our inflation view, to hike 4 times this year, which it's worth noting is at least 1.5, maybe 2 times what the market expects. We've really kind of seen the market move up a little bit, but for most of the end of last year, the market only had 2 rate hikes penciled in. So we think that the Fed can get 4 rate hikes done once a quarter this year.
Now, that probably means higher bond yields across the curve. So the front end, 2-year yields follow very faithfully the Fed funds rate. So you have the front end coming up. What happens with the yield curve, as Peter suggested earlier, it's a bit of a tug of war. If the front end, the Fed can move that up. The longer end is subject to what happens with inflation. We would just suggest, if we're correct and inflation does pick up over the course of the year, it's possible that the curve doesn't just continue to flatten. The curve could actually steepen up. And you've seen hints of that in the last week or so. So we do think it wouldn't be unusual for the curve to be flatter over, say, 12 months. On a shorter term basis, you could see a little bit of a steeper curve.
Finally, well, not finally, but second to last, the penultimate concern for us, as you know, credit and equities, we are bullish, largely as a result of our outlook. We don't think recession is imminent. So in the immortal words of our former colleague, get long, stay long, if you're in the equity market or credit.
And the final, I think this is where our view, the economics team view, is distinct from some of the other strategists that we see, and definitely versus the consensus. We think if actually U.S. growth is in the high 2s, so say 2.75%, if bond yields are rising, if the Fed hikes faster or hikes more than what is currently priced in to Fed funds futures, we think that is a backdrop that's actually bullish for the dollar vis-a-vis, say, the euro, or it's certainly against some other global peers. So that's something that I know is not popular, but we think, I guess if we listed, Peter, in terms of our conviction levels, probably the least of our conviction views. But we still think that's a non-zero probability that what's going to happen here is we get a little bit of an uplift in the strength of the dollar. With that,
well, thank you.
Yeah.
Thank you, Jeffrey and Peter. Appreciate your comments today. So at this point, we would like to take your questions. Please feel free to just scroll your mouse down to the bottom of your screen, and you see a chat function there between the record and the share screen. And you can just send a chat into the team. And as you're doing that, we have a few to teed off questions that came in during the comments today. So I will start with The first one, if we don't see inflation, what are the chances that we see the yield curve invert?
I think that's a very good question for two reasons. Not just because kind of the scenario we outlined with the longer end of the yield curve rising on the back of inflation, but also the risk that the Fed might be interested in waiting a little longer. So I think we don't think under any circumstances this year that the yield curve inverts. We would assign a very low probability to that, particularly if you look at that 10-year, 3-month bill yield curve. Now, it is worth noting, though, that I think the risk to our view in general, to our Fed view, is that maybe inflation does continue to disappoint and the Fed elects, despite some of their willingness to proceed last year with low inflation with rate hikes, maybe this year they decide, hey, until we see a material turn in inflation and an attendant pickup in wage growth, we don't want to continue moving front end yields higher. So I don't think, to the question, that we would expect a flattening really under any circumstance, but it is definitely a risk to our view that a miss on inflation could keep the Fed contained longer than maybe we expect.
Great. And another question that we had come through earlier is technology seems to be disrupting every industry. Is blockchain technology going to increase the rate of change? And then how do you see it being applied in finance and other industries?
Blockchain, Peter. I sort of feel, just off the top of my head here, blockchain is like the buzzword of 2017, maybe 2018. Given the run up in price of a Bitcoin, I think that's generated a lot of attention. I'm not sure how close we are to the technology actually being rolled out in some meaningful sense. I think it's just a buzzword at this point. But I mean, the bigger question for Natalie is more, okay, technology is ever present. We always, what we have with economic progress is a march towards more automation, and I think that's where we see some more disruption in the decade ahead. With many things that are now done by humans, we think will be automated away over the next 10 years. So I think the bigger impact for technology for me right now is the labor market impact of things like artificial intelligence, machine learning, those techniques being applied rather than blockchain. Blockchain, I think, is just more of a buzzword.
Great. And another question that came through is the unemployment number misleading? And are there outside factors that make this unemployment picture look better than it is?
The unemployment figure, so meaning the unemployment rate, that number we said we could get down to 3.5, that would be rare historically. So it's sign on its surface of being a really good labor market. Are there maybe some hidden elements to unemployment that's not being captured? Yes, but the way we go around that is we would look at a broader measure of unemployment that takes into account some of the weaknesses. For example, people that are working part-time that really want a full-time job. That is captured actually in the employment report in what's called the U6 measure of unemployment. The good news is U6 tracks the U3. It's also fallen rather dramatically. It's down around 8%. And we feel that it will also fall further in the year ahead. So this is not just a mirage that applies to the official unemployment rate. Broader measures of unemployment also have improved really dramatically in the last couple of years. So we think this is a great labor market. Probably the best labor market that we've seen in the data since the 1990s. And then you have to go back before that into the late 60s to find better signs of labor market strength. So everything from the number of job openings to the small number of unemployed to the very low level of layoffs, all these factors pointing to a really good labor market. So it's more than just the unemployment rate.
Great. Thanks, Jeffrey. It looks like we had a few questions come through the chat. So if you want to address those, that would be great.
We did have a couple of questions come in through the chat. One is in relation. So I think one question that comes up a lot is if U.S. rates are higher, maybe the dollar is a little stronger. What does that mean for the emerging markets, which are a huge share of the GDP story? And I think our backdrop here is that the global economy is in great shape. So what's people worry about, I think, is the 2013, 2014 era. The dollar strengthened dramatically. That had some negative consequences for global markets. The U.S. GDP backdrop in 2013 was very different, and the global growth backdrop was different as well. So actually what we're seeing right now, I think, is a very bullish environment for EM. You're talking about a 4% plus world GDP growth rate, which we have only seen probably a rate of growth or better 10% of the time in the post-war era. So this is a really good backdrop actually for EM. And so I'm not overly concerned. And I think if you talk to our EM strategist, right next door we have our good friend Darren, he would say, the EM, you can't paint it with a broad brush. So you have to look at country by country. You're talking about 70 countries now versus 10 years ago, you had a universe of maybe 30 countries. So it's just this much bigger, more diverse animal to wrestle with. So, but I think this macro story that we've laid out, just very bullish on growth, is good for EM.
We also had a few questions kind of related to the tax reform and some of the impact we expect both in the broader economy and in the bond market. And I think at the very highest level, we would say that tax reform, in our view, is probably net positive, but only a small positive, in that the views that we've articulated today, we probably would have held to the same extent with the same conviction had there not been tax reform. But to address two of the specifics, there was a question related to the impact on wage growth. And I think, as Jeffrey has described, what will really drive wage growth, hopefully this year, is the tightness of the labor market overall. And we've obviously seen plenty of newsworthy events, whether it's Walmart electing to raise minimum wage or
Starbucks.
Some of the one-off benefits provided by Starbucks. I think in our view, those are largely political posturing and probably responding to the fact that labor is a little more scarce and that they do have to pay more to retain those workers. The final thing I would say relating to kind of that low-end wage growth, there are very few people in the United States who are actually on a percentage basis of the total labor market who are employed at minimum wage. So the changes are very material, certainly for those workers, but from a macro standpoint, we don't really factor in for an incremental jump in, say, the Seattle minimum wage or the Los Angeles minimum wage as really driving wage growth. I think the most important thing in our view for wage growth, tax reform may help a little bit, but really the tighter labor market. The second thing, there were questions about repatriation as it relates to the bond market, and I think if we can say this somewhat humbly, but we are in a really unique position to kind of see this cross section, because many of our corporate clients are giving us money to manage because they were holding it overseas, and or are interested in investing in the debt that many corporates have issued because they don't want to repatriate cash. So I think we will see hopefully no material impact in a certain sense. What one hand giveth, i.e. the opportunity to repatriate, the other taketh away, because a lot of that overseas cash was actually invested in the U.S. corporate bond market. So I don't think it's, for us, I don't think we have a very strong view on whether it's not going to cause spreads to widen, but it's also probably not going to be something to hope for a massive rally in credit spreads as a result of that.
All right. Well, we thank you for your time today. And just as you go through the 2018, the year, remember, be wary, beware of the popular narratives that are out there. Be suspicious. I would say we would say be skeptical. Adopt a skeptical stance. And we wish you all a great year. Thank you.
Thank you.
And thank you all for listening to our team forecast today, we've included the dedicated funds team contacts and our general email address and phone number where you can reach out to receive our economic commentary and subscribe to our webcast series. And as mentioned, the recording of this presentation will be available and emailed shortly. And we thank you for joining us today and look forward to our next webcast in the series. Have a great day. Bye.